So what do you do when markets are rising and your overall portfolio is rising in particular, if not certain asset classes? Well, first off, great, feel good about that, celebrate that, and say, wow, that's terrific, it's working, it's the way it's supposed to work. Over time, markets do rise, and feel good about that, and understand that all that hard work you've been putting in and investing and maybe giving up some things to put more money into your portfolio and living below your means is now paying off. So feel good when markets go up, because invariably they come down at times too, but the overall trend is, and what we've seen through history, is that they do go up. There is a problem, though, with it. Like, how can there be a problem? I'm making money. It's great. One of the problems is behavioral-related problems or issues. One, you feel richer. You do. You look at your statements, your investment statements. Maybe you're tracking a few individual stocks that you have want to take a close eye at, or certain mutual funds or whatever. And you're like, look at them go up. This is great. And they're all going up maybe. And or certainly all the stocks are going up at the same time. And overall, it's doing great. And you feel richer. But the problem is, with these behavioral issues, you might feel overconfident. Look how great a stock investor I am. Look how good an investor I am. When overall you're rising with the rest of the market, right? A rising tide lifts all boats. Same thing. You're rising a portion of that with that tide. So don't be overconfident thinking it's all about you. Good part of it may be, but it's not necessarily all about you. And also, you might start feeling like, oh, my decision making is really awesome. I'm terrific. I know how to balance. I know what I'm doing. I know how to invest. I'm buying low and I'm selling high and all this good stuff. So don't feel that your decision making all of a sudden got better just because the whole market is increasing. And that also can lead to increased risk taking. Well, if I did even more, if I bought even more riskier investments, I could even goose or get a better return. So all these things of feeling richer, feeling good when the market comes up, can lead to these short-term types of behaviors or feeling, and you lose sight of your whole investment idea and what your goals are around that. And maybe you might even spend more on personal expenses, thinking, I've increased my wealth, at least I've increased it on paper, so maybe I can buy that new automobile or spend more money on travel, entertainment, clothes than I had planned to do, because I feel richer now on paper. So the idea is, don't get caught up in that, because as you'll see in the next lesson, markets do go down and you'll have differing behaviors and differing attitudes. So the idea and what you want to do is let your investments continue to run. Let them continue to rise. Continue to regularly add to your investments. Continue to adjust and automate your investments, and balancing your portfolio too. If you have certain asset classes that maybe have really taken off, well, that might be a time to sell those winners and then put them into some of the losers or things that are not going as well at that current time, because eventually they might turn around and become winners themselves. It's very cyclical in nature of the industry and with investing. So when one part of the market's up, another part of the market might be down. Entire asset classes like stocks and bonds may work in an inverse relationship. Certainly stock and like gold investments work inversely. By the same token, within stocks, maybe the healthcare stocks that you have are roaring, but your technology stocks are way down as far as in your mutual funds or the individual investments. So if you got a success in your healthcare funds, sell some of that and put that into your technology funds or other funds and rebalance your portfolio. Remember, you're having a portfolio that matches your risk tolerance and that is going to meet your future goals and those long-term goals. But the idea is you can sell high, buy low is the whole idea behind that. And when markets are rising, it's a good time. It's a feeling good time for everyone. But understand, they do fall eventually as well. And so compare it where your target and where you anticipate you want to be. As you get closer to your goal, that might be a time to really start selling off some of those things if you're close to your goal. Lastly is, you have this money on paper, but until you actually sell those investments, they're not realized investments, which means you have to also consider taxes and also fees and expenses for selling types of things too. So you might, once again, you don't have as much as you think you have. So do take that in consideration as well. But it's good news. Markets are rising. You're on track. You're meeting your plan. Feel good and celebrate that, but understand how your mindset and your behavior might change a little bit too. When we talk about when markets go down, especially if they go down as a broad market and significantly, you'll have the exact opposite feelings. And we're going to talk about that in the next lesson too. Like, maybe I'm not good at this investment game, or maybe I'm not going to meet my goals. The thing is, markets go up, markets go down. That's normal. That's natural. So when markets are going up, all tide is lifting all boats. That's great. So keep with your plan is the main part of that.